Today, we're diving into what is honestly one of the most bizarre paradoxes in the tech world right now. Look around, and we're literally living through an unprecedented AI boom, right? Anything even remotely attached to artificial intelligence is seeing its valuation just absolutely skyrocket. But right in the middle of this massive gold rush, a major AI enterprise software company, Five9, is watching its stock completely collapse. Get this, they just hit a record $1.1 billion in revenue, yet they are fighting off some seriously terrifying warnings from Wall Street. So, how does a company pivot to AI, massively grow its revenue, and still end up fighting for its life? Well, let's dive in and figure it out.
I mean, really think about it. How does a multi-billion-dollar AI company, one that's trusted by massive global enterprises, end up on Wall Street's dreaded zombie stock list? It's wild. Five9 deploys AI for customer service, which is an industry that is just desperate for innovation. But despite this amazing, compelling narrative, they are burning through cash at an alarming rate. To really understand this crazy clash between technological promise and financial gravity, we first need to look at the massive everyday problem they're actually trying to solve.
So think back to the last time you had to call a customer support line. You know the drill. You probably navigated a robotic menu, press 1 for sales, press 2 for support, waited on hold for what felt like 20 minutes, listening to awful music, and then had to repeat all your information to a human agent who was clearly frantically clicking through 5 different screens just to find your order. Why do call centers still suck so much? Well, as research from Persistent Systems points out, while the surface level of customer experience looks a bit more modern these days, the core systems underneath, they are still incredibly rigid. Data is scattered everywhere in little silos, and the really hard work of connecting all those dots falls on frustrated human agents.
To fix this absolute mess, the industry is migrating to something called CCaaS. That stands for Contact Center as a Service. It sounds like a simple definition, but it has massive implications. Basically, it means taking all those clunky, super expensive, physical, on-premise servers that run call centers and moving them entirely to the cloud, where they're accessed through a subscription. And here's the crazy part. Right now, large enterprises are only about halfway through making this migration. That leaves a massive, multi-year runway for companies operating in this space to grow.
But here's the thing. Just moving to the cloud, that's not enough anymore. The technology itself is totally transforming. We are finally moving away from legacy rule-based IVR. You know, those frustrating, heavily scripted, menu-driven answering machines that trap you in endless loops? The new holy grail everyone is chasing is modern agent AI. And we're not just talking about AI that answers basic FAQs. We're talking about autonomous AI agents that can actually do things, looking up data across different systems and conversing naturally, taking turns like a real person. The ultimate goal here? Resolve complex customer issues without a human ever having to intervene. That would drastically cut down the staggering $210 billion spent globally every single year on contact center labor. It's a huge prize.
And that brings us right to Five9, who is one of the big 3 incumbents in this cloud contact center space. But they aren't just resting on their cloud infrastructure laurels. They are aggressively pivoting to an AI-first model. Now, traditionally, Five9 made their money by charging a monthly subscription for every human agent sitting at a desk using their software. But now, they're rolling out what they call agentic AI monetization. Basically, they are charging premium fees for autonomous digital workers based on the volume of automated interactions. Let that sink in. They are quite literally selling the AI that is meant to replace the human.
Okay, so where does Five9 sit in this incredibly fierce competitive landscape? Well, let's break it down. On the low end of the market, you have Amazon Connect. That'll run you roughly $2,000 to $4,000 a month for a 25-agent setup. It's great if you're a team of developers who want to build your own system from scratch. Then, way up on the high end, you've got Genesys Cloud CX, which is built for massive, highly complex enterprises. And right there in the middle, in the sweet spot, is Five9. Averaging about $149 to $229 per agent, they are perfectly positioned for mid-market to large enterprises. They're targeting the guys who really want these advanced AI features, but absolutely don't want to build the whole shebang themselves.
Now, this narrative sounds absolutely fantastic, right? Cloud migration plus AI efficiency equals massive profits. Simple. But as you'll see, the reality on the ground is a whole lot bumpier. Industry analysts and real customer reviews are highlighting some pretty serious hurdles. We're talking buggy answering machine detection, dropped calls, and super complex features that are just plain hard for teams to master. Plus, getting everything to talk to each other isn't exactly cheap. For instance, just connecting Five9 to Salesforce can cost around $13,000. Ouch. Customers are quickly finding out that actually deploying this cutting-edge AI is way, way harder than the smooth sales pitches make it seem.
And this friction?
It's captured perfectly in a recent Cavell report, which actually summarized feedback from attendees at Five9's very own summit. Customers directly reported unrealistic expectations of rapid containment and instant ROI. In practice, they said these AI deployments required lengthy tuning cycles and saw really low early success rates. So what does this tell us? There is a dangerous, glaring gap between the marketing hype of magic autonomous AI and the heavy, grinding engineering required to actually make it work in a real-world business.
But wait, the friction isn't just technical, it's also deeply structural. Enterprise operations teams are getting seriously frustrated. A lot of these shiny advanced AI features are gated behind higher pricing tiers, or they're sold as these kind of opaque add-ons. And the contracts, they are rigid. We're talking auto-renewals with baked-in 5% annual price hikes. Furthermore, Five9 relies really heavily on third-party partnerships for unified communications. That means they don't offer a seamless, all-in-one platform for both internal team chat and external customer calls. When you add all this up, it creates a pretty significant drag on overall customer satisfaction.
And here is where the story takes a dark turn. All of this operational friction, it eventually bleeds right into the financial reality, and Wall Street has absolutely noticed. An investment research firm called New Constructs recently slapped Five9 with a truly brutal designation. They added them to their zombie stock list. Now, if you aren't familiar, a zombie stock is essentially a company that is entirely unprofitable, burning through its cash reserves at a dangerous pace, and facing a really high cost just to raise new capital to stay alive. Despite the massive AI boom happening everywhere else, financial analysts are looking at Five9's balance sheet and seeing some massive, glaring red flags.
And honestly, this is the number that is absolutely terrifying investors right now. Negative $299 million. Yeah, that is Five9's free cash flow burn over a 12-month period according to New Construct's calculations. Think about that. While the company's out there boasting about top-line revenue growth, the actual hard cash going out the door to fund their operations and heavy R&D is vastly outpacing the cash coming in. In an economy where interest rates are significantly higher, burning nearly $300 million in a single year isn't just a red flag, it's a glaring, blaring siren.
As you'd expect, that kind of massive cash burn has completely crushed Five9's valuation. While the rest of the tech sector has literally been riding the AI wave to record all-time highs over the last couple of years, Five9 stock has drastically, and I mean drastically, underperformed the broader S&P 500. Retail investor sentiment is deeply scarred right now, and this is creating a massive headache for the company's leadership. They are under immense, very public pressure to prove to everyone that this AI pivot actually works as a sustainable business model.
Because of all this, analysts have outlined a really urgent financial reality. There is quite literally a ticking clock on this company. Check this out. Five9 hasn't generated an actual annual profit since 2019. On top of that, their cost of capital has risen past 10%, which makes it incredibly expensive to borrow any new money to keep funding that cash burn. In fact, based on their cash on hand versus their current burn rate, New Constructs estimates they have roughly 24 months left until bankruptcy. 24 months. If they don't engineer a massive turnaround and fix their margins, and quickly, time runs out.
But hey, remember how we called this a paradox at the beginning? Well, it isn't entirely doom and gloom. There's actually a very real, very compelling bull case here. Five9 is not some dying, irrelevant legacy company. Like we mentioned, they just posted a record $1.1 billion in revenue for 2025. Their core subscription revenue is still growing at a healthy 13% year over year. They are also successfully shifting their enterprise clients over to fixed revenue commitments, which locks in much more predictable cash flow for the future. Plus, they just launched their highly anticipated AI Agent Studio, which is a platform specifically designed to make deploying those autonomous digital workers much easier and more secure. So the technology is undeniably advancing.
So when you put it all together, we're really looking at two very distinct, very different possible futures for Five9. Future one is what we'll call the standalone AI success. In this scenario, their new tools scale it perfectly, they successfully swap out human seats for high-margin AI fees, and they finally cross the finish line into true profitability. But then there's future two, the take-private or acquisition scenario. In this world, the cash burn just keeps going. The AI tuning cycles stay way too long, and right before that 24-month clock runs out, they are basically forced to sell themselves at a massive discount to a larger tech conglomerate or a private equity firm.
Which brings us to our final thought today. The market has absolutely punished Five9, pushing its valuation down to an extreme discount. But is this company just a misunderstood value trap that's going to keep torching cash? Or is it actually the ultimate turnaround play, sitting right smack at the heart of the AI customer service revolution? Because make no mistake, The shift to agentic AI in call centers is entirely inevitable, but whether Five9 successfully cashes in on it or simply becomes another casualty of its own AI hype cycle, well, that's a multi-billion-dollar question. What do you think?